Hi, this is Sadiq Adesha, Chief Investment Officer for Sun Life Global Investments. As we begin to settle into a new normal, the markets are still showing signs of heightened uncertainty. In March, we saw the CBOE Volatility Index go above 80, which is quite extreme. Lately, it has been in the 30s and 40s, but that is still double the long-term average. As we move into the next phases of the pandemic, we continue to manage risk while looking for opportunities for the longer term. Join us as we present part 2 of our Quick Take series. At Sun Life Global Investments, we go through a rigorous process to select and monitor sub-advisors from around the world. In our Quick Takes conversations, these sub-advisors provide important insights into their regions or asset classes. We hope that this diverse coverage will help you manage and stay informed through this period.
Hello, thank you for joining us today as we speak with investment specialist Tim Lisk from JP Morgan to discuss the Sun Life JP Morgan International Equity Fund. Tim, how has the asset class been impacted by the events in Q1 2020?
Well, thank you for the question. So how does an active manager try to navigate a crisis like COVID-19? Well, it's fair to say this is unlike anything we have faced before. What is unfolding is a deep shock to the global economy, with, of course, a profoundly tragic human element to it. So while we are acutely concerned for the health and safety of our families, friends, colleagues, and clients, we are at the same time wholeheartedly engaged with navigating portfolios through this crisis. Our international focus strategy is a high-conviction portfolio of our 40 to 50 best ideas outside the United States. And we came into this year off a strong 2019, with the portfolio up over 24%, more than 9% above our MSCI All-Country World ex-US Index. While our clients are happy when we outperform our index in a strong upmarket, what has been especially important has been this volatile first quarter, where our portfolio also held up better than the index in a strong down market. This environment has only reinforced our philosophy, namely that quality companies with strong fundamentals at reasonable valuations should outperform over a market cycle. The scale and scope of this crisis may be like nothing we've seen before, but we turn, as we have in prior crises, to 3 simple priorities. 1, identify and mitigate any new risks to the companies we are invested in. 2, think about the new opportunities that will come our way. And 3, reinforce conviction in building the right portfolio for the recovery and long-term beyond that.
Are there any sectors or regions that are more attractive given the sell-off in Q1?
Well, intuitively, one would indeed expect that given this backdrop, there are sectors or regions that have become more attractive given the sell-off. However, I have to say up front that instead of focusing on regions or sectors, the balance here has been to favor thinking about opportunities for the long term and staying focused on companies with the best long-term prospects. There is really little to be gained from getting overly defensive at this stage, especially when perceived safety carries a hefty premium. We have been more focused on what life will look like on the other side as we emerge from this crisis. Through a combination of policy intervention and natural checks and balances, the economy will survive and life will return to normal. It's vital not to lose sight of that even as we become transfixed by an alarming daily news cycle and a lot of volatility in the markets. So, on the first of our 3 key priorities, namely to identify and mitigate new risks, we've focused on testing the balance sheet strength of the companies we own. Our investment process deliberately looks for companies with sound balance sheets and strong cash generation. While the typical company we own in the portfolio has a very solid financial position, many have still felt it prudent to take action to reduce costs, delay spending on capital expenditure and dividends to conserve cash until there is more clarity on the impacts of this crisis. Some companies have used credit facilities where revenues are under particular pressure, but none of the companies we own have, so far, issued new capital. This speaks to the much better financial health many companies find themselves in today compared to 2008. This does not feel like the liquidity crunch of 2008. Balance sheet and systemic risks are being well managed at this stage, and we'll feel confident in the financial strength of all the companies we own and their ability to withstand a prolonged slowdown.
Have there been any changes to the fund?
Yes, there have been, and I think it best to set these against the second and third of our 3 key priorities, namely to focus on identifying new opportunities presented by the sell-off and to reinforce conviction in building the right portfolio for the recovery and long-term beyond that. The sectors that are sold off most aggressively have been areas like travel, leisure, consumer cyclicals, banks, and industrials. This makes sense with the economy going into suspended animation for a period of time. However, a global perspective is helpful in thinking about the pace and shape of the recovery when it comes. China experienced the pandemic first, and there is mounting evidence of easing lockdown measures, increasing economic activity, and a return to normal life. One of our Asian analysts commented back in April that car dealerships in China were already seeing activity back to 90% of normal levels. We look at South Korea and Taiwan, and we can see what life might look like with more comprehensive testing, proper track and trace procedures, and can imagine a new normal, which might not be that different from the old normal. And, of course, should a vaccine be developed, then that will speed the normalization process. So while we could spend a lot of time worrying about the impact to earnings this year and next, over a longer horizon, these events should not make a dramatic difference to the value of most companies in 5+ years' time, in our view. It's in that light that we've been active in adding new high-quality names to the portfolio in areas like consumer, industrials, and financials. We've added a new position in the highest quality hotel operator outside the US, based on our view that demand will recover strongly over a longer-term investment horizon. Another example would be a European industrial company, which is one of the world's leading companies in its segment with close to 20% market share, which we added to last quarter. These businesses do face an uncertain few months because of the sectors they operate in, but make no mistake, will continue to create and compound significant value for shareholders once the crisis eases. When the market prices in long-term damage to great companies because of a short-term crisis, that really is the opportunity for an active manager to pounce on. Europe has inevitably been in focus for investors, with Italy, Spain, and the UK experiencing relatively high death tolls from the pandemic. But again, like China, having experienced the pandemic earlier than the United States, we should expect recovery and normalization more quickly. Also, the scale of the social safety net in Europe may prove a blessing in this crisis, with less dislocation for consumers compared to the US. Nonetheless, investor concern over the health of the Eurozone economy and the banking system have re-emerged. We remain confident that this should not be a rerun of the sovereign debt crisis of 2011-12. The European Central Bank stands ready to support government bond markets, and the banks are in significantly better health, with capital ratios strong and profitability much improved versus 7 to 8 years ago. So, when we see European banks trading on similar valuations to previous crises, around 0.5 times price to book value, we think that presents opportunities at the higher quality end of the sector. So, the actions we have undertaken are to reinforce conviction in the very strongest companies, which, if history is any guide, will emerge from the crisis in an even better position. In every crisis, it's the weaker competitors that fall by the wayside, while the best positioned companies enhance their position. In other words, the strong get stronger. There will be some sectors of the market where prevailing positive trends accelerate. Think about the shift to online platforms for food delivery, working and learning. We have and continue to own a number of companies seeing substantial growth on the back of this. One of our holdings, which spans Europe, Asia, and a number of emerging markets, has seen a substantial uptick in order volume since the crisis hit. They are also using their balance sheet strength to consolidate markets they operate in to become the undisputed leader. As ever, with the international focus strategy, we endeavor to build a portfolio of high-conviction holdings which captures the very best thinking of what we consider to be a world-class research platform in international markets. While this pandemic is uncomfortable and unprecedented in so many ways, a focus on owning great companies for the long term and taking advantage of the opportunities which volatility and market distress present will, we hope, continue to be a valuable combination for our clients. Stay safe.